Imagine waking up one day to find that everything feels more expensive, even though borrowing money has never been cheaper. Sounds backwards, but that's exactly what happened across much of the world. For years, interest rates stayed unusually low. Central banks cut rates to encourage people to borrow, businesses to invest, and economies to grow. On paper, it looked like a win for everyone. Cheap money, more spending, more growth. Simple. Except it wasn't. When borrowing becomes cheap, people don't just buy more things. They bid up the price of the same things. Take housing. If mortgage rates fall from 7% to 3%, buyers can suddenly afford much larger loans without increasing their monthly payment. But houses don't magically multiply overnight. More buyers begin chasing the same limited supply. The result? House prices climb. The same thing happens with stocks, commercial real estate, and even startups. Investors can borrow at lower costs, so they're willing to pay higher prices today, expecting tomorrow to justify them. Cheap money doesn't stay cheap. It gets baked into the price of everything. Now here's where the story becomes uncomfortable. When assets become more expensive, people who already own them often become wealthier without doing anything different. Meanwhile, first-time buyers face a much steeper climb. The gap quietly widens. Then businesses join the cycle. Instead of asking, "Can we afford this?" the question becomes, "Why not borrow?" Debt piles up because servicing it feels easy. Governments borrow more. Companies borrow more. Consumers borrow more. As long as interest rates stay low, the machine keeps running. But machines have switches. When inflation starts rising, central banks usually raise interest rates to slow spending. Suddenly, yesterday's cheap loans disappear. New borrowing becomes expensive. Monthly payments increase. Asset prices wobble. The same debt that felt harmless starts feeling heavy. It's a strange irony. Cheap money was designed to make life more affordable. Yet over time, it often made homes, investments, education, and even everyday living more expensive because easy credit increased demand faster than supply could keep up. The money itself wasn't the problem. It changed how everyone behaved. That's the hidden power of interest rates. They don't just influence what things cost, they influence what people believe things are worth. And maybe that's the real question. If an entire generation has learned to live in a world built on cheap money, what happens when money is no longer cheap?